Hello, my name is Edmond Jamna, and on behalf of DW Consult, I want to welcome you to Tutorials on the Go. Our zeal here is to help transition people with zero, struggling, or shaky base in accounting to an expert position and to a place of confidence. It is also a platform to assist in the smooth studying of the ACCA and ICA professional qualifications, as well as for any tertiary accounting discipline. All that is required of you is to subscribe to our channel and click on the notification bell as well to be part of the program. Tutorials on the Go, bringing accounting to heart. Now, to this episode's lecture, sales tax. Now, let's look at the definition of a sales tax. This is a charge of a predetermined percentage on the original sales and purchases of most goods and services. So normally, businesses will put together factors to determine the cost of producing a product or the cost of delivering a service to a client. And they will add a profit element on it to arrive at a selling price. Now, what the sales tax does is that the government will appoint or authorize a business to add an additional amount of a certain percentage, which is known in the country. Sales tax is also known as value-added taxes, as the name implies. It is added onto the cost of the item to arrive at a new selling price. It is an indirect tax because it is not slapped directly on the income that individuals or businesses fetch. It is through the purchasing of goods and services. So examples of sales tax will include GET Fund, NHI, which is the National Health and Insurance Levy. We have VAT. Let's look at certain principles that apply to sales tax. The first of it is an agent. Now, this is an entity registered or appointed by government to charge sales tax. Now, mind you, it's not every business that has the mandate to charge sales tax. They have to be authorized by the government. Tax that a business incurs buying from their suppliers, who are tax agents, is known as an input tax. Now, output tax, on the other hand, is a sales tax that a business charges customers, the one that is factored in their selling price. Now, when the output tax exceeds the input tax within a period, the excess is supposed to be paid to the tax authorities or the government. That is what is known as the tax payable. On the other hand, if the input tax exceeds the output tax, the government is supposed to pay them the excess. That is what is known as the tax credit. Now, the period is where the business is supposed to remit the tax that he or she has collected, less what it has suffered, and then pay to the government. It is done over a month in some jurisdiction and quarterly in other jurisdictions. Let's now look at the calculation of sales tax. We first have the net selling price, which is the tax exclusive amount. That is the original selling price which the business intended to sell its products or services. Then we have the sales tax. Then the addition will arrive at the gross selling price, which is also known as the tax inclusive amount. For calculation purposes, the net selling price is always deemed to be 100 because that is what the sales tax is supposed to be calculated upon. Then we bring the sales tax is always determined by the government. It's not determined by the business. So the sales tax is always known in every jurisdiction. So in this example, we'll take the sales tax to be 10%. So the gross selling price will now be 110, which is the addition of the sales index plus the sales tax rate. Now, when you are giving the tax exclusive price, if you're supposed to find the sales tax, it will be the 10 over the 100 times the tax exclusive price. In a situation where you know the tax inclusive amount and you have the sales tax rate, finding the sales tax amount will be 10 over the 110, which is the percentage for the gross selling price, times the tax inclusive price. In a situation where the tax inclusive price is available and the tax rate is also available, to find the tax exclusive price, you take the 100, divide by 110 and multiply by the tax inclusive price. Finally, if you have the tax exclusive price and you have the sales tax rate available, to find the tax inclusive amount, you divide 110 by 100 and multiply by the tax exclusive price. These are short methods of arriving at various elements of the calculation. There are other long way means where if you have the selling price and you have the sales tax, to find the gross, you just have to find the sales tax first, then add it to the selling price, which is illustrated at the top. Let's test our understanding on what we have discussed so far. Now, Kofi sells the following goods. A, to Mickey at a tax exclusive price of $1,200. B, to Richie at a tax inclusive price, which is the gross. So how much sales tax is Kofi collecting on behalf of the government if the sales tax is 17.5%? Now, let's look at Mickey. The tax exclusive price is available. So it's going to be the 17.5 divided by 100 times $1,200, giving us $210. For Richie, the tax inclusive price is what we have been given. So it's going to be the 17.5 divided by $117.5 times the $7,000, giving us $1,042.55. Let's test our understanding on another scenario. Now, AMA sells goods at a net price of $1,500, which is a tax exclusive price. The rate of sales tax is 10%. Now, we are supposed to find the gross, which is the tax inclusive price. We're first going to look at the simplified format. When you have the net, which is the tax exclusive price, and you want to find the inclusive price, it will be 110. So divided by 100 times the amount exclusive of tax, giving us $1,650. If we want to go the long shot, so gross amount is the net plus the sales tax. We know the net amount, which is $1,500 given in the question. The sales tax is 10%. We find 10% of $1,500, which will give us $150. When we add the two, we are supposed to arrive at an amount of $1,650. Another example, Zeta sells goods at a gross, which is tax inclusive price of $2,000. The rate of sales tax is 16%. So we are supposed to find the tax exclusive price. Now we have the tax inclusive price, the tax rate available, looking for the tax exclusive price. So 100 divided by 116 multiplied by $2,000. So the exclusive selling price will be $1,724.14. The long shot will be that gross amount is always the net amount plus sales tax. So you're supposed to find the net amount. It will be the gross amount less sales tax. This is pure mathematics. The gross amount is known. To find sales tax, it is going to be 16, which is the tax rate, divided by 116 times $2,000. It is very important to get yourself conversant with the simplified format that we outlined earlier. The sales tax will be $275.86. Less it from the tax inclusive amount, we are going to arrive at the same figure above. Next test of our understanding. Martinez purchases goods for $200,000, inclusive of sales tax, and sells the goods for $500,000, also inclusive of sales tax. The sales tax is 15%. So what amount of sales tax is ultimately payable or receivable to or from the tax authority? So we are looking at whether the output will exceed the input or the input exceeding the output. Estimating the tax amount when the inclusive is available will be the 15 divided by 115 times $200,000. Giving us a sales tax of $26,086.96. Output tax, it's also going to be 15 divided by 115 times $500,000, giving us $65,217.39. The output is more than the input, so there's a tax payable at hand, which will be $39,130.49. So this is supposed to be paid to the government at the end of 1 month from the time this estimation was done, or quarterly, depending on the jurisdiction that you find yourself in. Let's look at accounting treatment for sales tax. We'll first deal with the input tax. You debit the purchases account with the net or tax exclusive amount. You also go on to debit the sales tax with the sales tax amount. Then you credit the cash account if it was a cash purchase, or payables account if it was a credit purchase, with the tax inclusive amount. When we move to the output tax, we'll have to debit the cash account if it is a cash sales, the receivable account if it is a credit sales, with the tax inclusive amount. Then we credit the sales account with the tax exclusive amount. Then we credit the sales tax with the sales tax amount. Now note that in the statement of financial position, the purchases that you will see will be exclusive, so is the sales. Let's also look at accounting treatment when the tax is paid or is received. We'll treat the tax payable first. So when a tax is paid, okay, you have to debit the sales tax account and you credit cash account with the excess of the output over the input tax. When we come to the tax credit, we'll debit the cash account if the money is received, or the receivables account if it's going to be received. Then we will credit the sales tax account with the excess of the input over the output tax. Let's test our understanding. We are going to take the solutions from the test of understanding of AMA solved earlier. So from that example, we realized that the net sales was $1,500. The sales tax was $150, giving us a gross sales of $1,650. So we'll open the sales account, credit it in the name of cash, assuming it's a cash sales, with $1,500. Then we close it. We come to the sales tax account, credit it in the name of sales for $150, the sales tax amount. Now sales tax becomes a liability. It is arising out of past events because you traded with people when you collected the money from them. Settling of this sales tax will lead to money going out. So it definitely passes all the criteria of a liability. So we'll bring the balance on the debit, which is the 150, and carry it to the credit below the total line. We come to the cash account. We will debit it with $1,650 and name it sales and sales tax. Cash is also an asset, so we close and balance it by crediting it and debiting it below the total line with a balance of $1,650. Let's look at the entry for purchases. We'll also pick the solutions in the case of Martinez. In that example, the net purchases was $173,913.04. The sales tax was $26,086.96. The gross purchase was $200,000. So we open the purchases account, we debit it in the name of cash, assuming we paid with cash by the $173,913.14. We close it by putting a statement of profit or loss, which will be transferred to that account. Open the sales tax account, debit it in the name of purchases with a sales tax amount of $26,086.96. Because it's a liability, we close it by balancing it on the credit side and moving it to the debit below the total line. We also open the cash account, credit it in the name of purchases and sales tax with a tax inclusive amount of $200,000. And because it is a cash account, we balance it on the debit with $200,000 and bring it below the total line also for $200,000. So guys, that is all we have to discuss under sales tax. I believe you have gained much understanding about this topic. If there's anything that you need further clarification on or any feedback that you have for us, kindly drop them in the comment section below. Don't forget to subscribe to support our course. Click on the notification bell, hit the like button, and share. Thank you very much for your time. Till we come away again by way of tutorials on the go. Take care of yourself and stay blessed. Poker.